Hey there. Chances are you've heard terms like index funds, mutual funds, hedge funds, or ETFs tossed around at dinners or popping up on social feeds where suddenly everyone sounds like a money expert. But what exactly are these things? And which ones should actually matter to you? Stick with me for the next 5 minutes. I'll break this all down in plain, no-nonsense language. No Wall Street jargon, no fancy suits. We'll talk about what a fund really is. Spoiler alert, it's not some exclusive insider club. Well, hedge funds kind of are. We'll run through the main types, how they're managed, what risks and fees you need to know about, and most importantly, who each type is designed for. But first, here's the standard disclaimer. This is not financial advice. I'm not your financial planner, your cousin who reads stock blogs, or Warren Buffett's secret buddy. This is just for learning and maybe a bit of entertainment. So what is a fund anyway? Picture this. You and your friends are throwing a birthday bash. Instead of one person paying for the pizza, cake, and a DJ who only spins A-B-B-A remixes, everyone throws a little money into a single pot. Now, you've got enough to throw an amazing party without anyone stressing over the bill. That's basically how a fund works. A fund is simply a group of people pooling their money. That combined cash is invested in a mix of things. Stocks, bonds, real estate, maybe even rare artwork if you're feeling fancy. Instead of you spending hours trying to guess which stock might explode like a lottery ticket, the fund does the heavy lifting. You just invest. Let the fund handle the details, and hopefully enjoy watching your money grow. Index funds, the relaxed genius of investing. You've probably seen influencers yelling, just put your cash in an index fund and forget about it. But what does that even mean? An index fund is basically a copy machine. It doesn't try to predict which companies will win big or flop. It simply follows an index, which is a curated list of companies that represents a piece of the market. Think of an index as the market's scoreboard. The S&P 500, that's an index of the 500 biggest US companies. If it goes up, it means the economy's heavy hitters are generally doing well. The Nasdaq is home to big tech names like Apple, Microsoft, and Amazon. The folks who make your phone, your work software, and your online shopping addiction possible. There are indexes for everything. Industrials, Dow Jones, small companies, emerging markets, even niche sectors like healthcare or energy. Index funds just mirror these lists. No guessing games, no caffeine-fueled stock pickers in suits. They're passively managed, which is great news. Fees stay incredibly low, sometimes as tiny as 0.02%. That's about 20 cents on every $1,000 invested. You probably can't even grab a vending machine snack for that. Big names like Vanguard, BlackRock's iShares, and Fidelity dominate this space. And since your money's spread across hundreds of companies, your risk is relatively lower. Though, of course, don't expect instant riches overnight. Quick tip. Index funds don't trade like stocks. They're priced only once a day after markets close. So if you buy at 11 a.m., your purchase price will actually be whatever it settles at that evening. Forget about lunchtime day trading here. Mutual funds. Index funds' ambitious cousin. At first glance, mutual funds look like index funds. Both pool investors' money and invest in a basket of assets. But here's the twist. Mutual funds are usually actively managed. That means there's a manager, or a team, trying to outsmart the market by picking the right stocks at the right time. Sounds great, right? The catch. Most research shows they don't consistently beat the market over the long haul, and they charge higher fees for trying. Mutual fund fees often range from 0.5% to 1.5%, sometimes even more. Still, some investors prefer mutual funds for specific reasons. They may want exposure to markets or sectors that index funds don't cover, or they believe in a particular manager's skill. Major players include Vanguard, Fidelity, and JP Morgan. Like index funds, mutual funds only execute trades at the end of the trading day. Place your order anytime, but don't expect immediate action. Hedge funds, the thrill seeker's playground. Now, let's spice things up. Hedge funds. The name sounds protective, like they're all about reducing risk. In reality, hedge funds are more like financial daredevils, chasing big returns using bold, sometimes wild strategies. They invest in everything: stocks, bonds, currencies, real estate, even derivatives. They may short sell, betting on companies to fail, or use leverage, borrowing money to invest even more. It's a high-stakes world. Huge potential rewards, but equally huge risks. Hedge funds are typically only open to accredited investors. Think ultra-wealthy folks or institutions with cash to burn. And the fees? Famous 2 and 20 model, 2%. Annual management fee plus 20% of any profits they earn for you. That's steep. If things go wrong, you could lose a hefty chunk of your investment. ETFs. The cool middle child, finally. Meet ETFs, exchange traded funds, the hybrid star of investing. ETFs borrow the best parts of index funds and stocks. Like stocks, you can buy or sell them throughout the day at a live price. Like index funds, they pool investors' money to invest in a broad range of assets, giving you instant diversification. Most ETFs are passively managed and track indexes, so their fees are often extremely low, commonly between 0.03% and 0.75%. And most trading platforms let you buy them with no commission. Want exposure to the S&P 500. An ETF can get you there just as easily as an index fund, but with the flexibility of stock-like trading. So, which one's for you? For most regular investors, index funds or ETFs are the sweet spot. Low fees, easy to understand, and diversified enough for long-term growth without needing to check the market every hour. Mutual funds might appeal if you're loyal to a particular fund manager or want access to markets that index funds skip. Hedge funds, unless you're a thrill-seeking multimillionaire, they're probably not your scene. And there you have it, a crash course on funds without the dry finance textbook or a Wall Street power suit. If you found this breakdown useful, give it a like, subscribe for more simple money talk, and check out the next video. You'll probably love it. Thanks for tuning in, and I'll catch you in the next one.